PMI data is due to show that the U.S. economy continues to soar. So what could possibly go wrong? That's what we're going to ask here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We have the upcoming January 1st look at Global Purchasing Manager Index, or PMI data, that is going to be in focus for us today. This, of course, is something that is a very closely watched way to estimate what global growth trends are if you don't want to get stuck looking at perennially delayed quarterly GDP numbers. Not only are they released late, but the trends they show are very dated by the time you get them. Markets, of course, still react, but that is not the most timely way of looking at things. These PMI numbers, however, are a great way to approximate. These are surveys of purchasing managers at large corporates that, because they have to manage inventories and such, have to, by virtue of what they do, look ahead. And so this becomes a good reflection of where global growth is going in a more timely way. And the expectations that we're looking at here for the major economies due to come across the wires here, they look relatively benign. If you look at the US, much less so if you look elsewhere, and generally in line with the trends that we have seen. So consider here that for the major economies here, the story is that of continuation. Slight positive growth in Australia, a little bit of a cool down maybe in Japan, but not much. About the same for the composite index there. The Eurozone still in trouble, third consecutive month of contraction expected there. Just to make sure that we're on the same page, the way that this is marked, of course, is around a center line of 50, which is neither growth nor expansion. Above 50 is growth. Below 50 is contraction. The more you get above 50, the faster the growth. The more you get below 50, the faster the contraction. And so what we're looking at then for the Eurozone in seeing a number that is sub 50 is contraction. And this would be the third consecutive month of that. On to the UK, relatively flatlined there. But for the US, strength on strength on strength. Another potent reading here. And in fact, if we want to consider what the trend here looks like, the history is very kind to comparison here. So we're looking in January for just a bit of a downtick on the composite as the service sector cools just a touch. And if we compare this to the recent history, the reference points take us all the way back to April of 2022. So very strong growth in the U.S. Here around this area that's relatively sort of elevated in the comeback from COVID story, of course, already on the way down from those heady catch-up levels as the economy was reopened and started to surge forward as things turned back on, but still very much at the high end of what has become the sort of post-COVID normal. Compare that with the Eurozone. So again, not much changed from December's numbers, but still relatively anemic, and extending this sort of slide from middle of 2024 that is now giving us the worst performance, if this comes out essentially as expected, the worst 3 months here since basically here, the beginning of 2024, the slowest 3-month run in a year. And the reason we focus on the US and the reason that we focus on the Eurozone and single those out is because, of course, the global economy is overwhelmingly driven by 3 major economies. The US is a little bit over a quarter. China is at 17%. The Eurozone is at 15%. And these 3 economies between them are 58% of global GDP. Moreover, the remaining 42% are mainly vendors that depend on buying from the larger 3 to have demand of their own. So think all of the economies of Central, Eastern Europe, Nordic Europe. When you're thinking of the Eurozone, think Canada, Mexico. When you're thinking of the US, think Australia, New Zealand, most of Southeast Asia, a lot of the commodity producers in South America when you think of China, and of course the commodity producers in Africa as well. So the impact that these 3 economies have is, in fact, even greater than their share of GDP suggests. And so the overall global pie really rests on these 3 pillars. And as we just saw, what these PMI numbers are going to show us that once again, the US stands alone, whereas the situation in the Eurozone is looking anemic. Now, we're not going to get updated numbers from China until next week, but we can see here that the situation there has basically struggled for liftoff since the country exited zero COVID restrictions in late 2022 going into 2023. We saw a bit of a rise in the service sector side of things as those that were in lockdown were let out. But since then, we can see within just a few months, the situation anchored back, this is the 50 line right here, to essentially hugging neutral. And that's if you look at the comparable S&P Global PMIs, which is what we have here, that's done in conjunction with Caixin, or the official ones that come out of China's government statisticians, the NBS as well as the CFLP, the purchasing and logistics arm. You can see here again, surge in early 2023 as you get this reopening, and then a kind of sinking to hug the neutral, not going anywhere, not growing, not shrinking kind of setting. And that, of course, is how, when you look at the dynamics of overall global growth, you end up with something that is much more anemic than the U.S. situation would imply. So take a look at, once again, what's going on with the U.S. We're booming and we're sitting at levels that haven't been hit in over 2 years, 2.5 years, whereas when we look at these global averages, we're sitting at maybe on the composite index here, the highest levels since about mid last year. But ever since peaking in May, what we've seen is a deceleration. And largely, this is because what we're seeing in the U.S. is a story stuck in the U.S. rather than something that is going to emanate to the world at large. In fact, just last week, what we saw was CPI data that once again showed us that the service sector is overwhelmingly in charge when it comes to price structures. As a matter of fact, if we take a look at how much contribution there was to overall inflation from the service sector, it was a whopping 93%. And that has in fact been the norm in 2024, in 2023, where the economy is overwhelmingly skewed to the service sector. Compare that with 2021, 2022, where the average was closer to 35-40% of inflation was in the service sector. And that, of course, is an implication of demand. When there is greater demand, there is greater upward pull on prices. And so backing out from prices to look at, okay, well, all of inflation is apparently in services. That must be where all the demand is. That seems to explain how it is that you have the world's largest economy, the biggest contributor, in fact, to overall global GDP, surging, but the global economy is doing nothing of the sort. It's not falling apart, to be sure, but it appears more so to be idled in place around these levels here. So positive growth, but modest by comparison when we look at the heights being scaled by what's occurring in the US. This is, of course, because the services boom that we have in the US is mainly serviced by domestic firms. That demand is satisfied largely in-house, as it were. In fact, the anemic state of Canada's economy, which has struggled to grow in any kind of capacity over recent years, is a case in point. Canada exports 80+% of everything it sells overseas to the US for obvious proximity reasons. But the US is booming, yet Canada is struggling. Were there to be spillover from the US and how strong it is, Canada would be the first place to look and see. And that spillover is plainly not there. So what we're looking at then is a situation where there is an increasingly lopsided story for growth, and that lopsided story certainly favors the US, but it leaves global growth without much of a leg to stand on in terms of lasting and building performance, because everywhere else appears to be weak, and of course, most notably in Europe and in China. Meanwhile, what's happening in the US is not making its way outward beyond US borders in any kind of a meaningful, accelerating way. There is, of course, a dark side to just staying inside the US economy for growth where everywhere else is weak, because the thing that the US is exporting, not demand, but higher interest rates. We can see here in the green is the US 10-year. In the blue is an average of the 10-year rate for the other major economies here. Germany as a stand-in for the Eurozone, the UK, the Australian dollar, and Japan. These are the world's most traded currencies. And so these are the debt instruments that we're benchmarking for the global story. And what we find here is, while the Eurozone is seeing rate cuts, Japan is seeing rate hikes, but they're only very modest, and the UK is cutting rates, Australia is standing still, not exactly the world's greatest impetus there for higher rates, and they are surging nevertheless. And that's not just through this global hiking cycle, that's here and now. And that, of course, is because rates in the US are doing that. And this speaks to, of course, the ubiquity of the US dollar and its wide use in global commerce. So when the market takes a more hawkish view of the Fed, as they have in recent months, reckoning that essentially the strong U.S. economy will mean the Fed is not going to be in a position to cut rates as much as markets thought, or even as the Fed thought, that emanates out because the cost of borrowing dollars, because of the dollar's ubiquity, becomes the cost of borrowing for global business in general. So you're left with a situation where all the U.S. is doing for the global economy with its outperformance is introducing higher borrowing costs. And that, of course, is more digestible for the U.S. economy, which is growing quickly, and less digestible for the rest of the global economy, which isn't. That comes at a time when stress is already rising on the credit structure globally. We can see here from the latest Global Debt Monitor report, this was published late December from the Institute of International Finance, we find here that there is a big redemption cliff, both for mature markets and even more so for emerging markets in the coming year. Moreover, the situation is going to be amplified unlike any other time in history because, as we've pointed out before, since the 1970s, which is essentially the birth of the modern financial system that occurs with the decoupling of the dollar from gold, every tightening cycle has seen corporates pay more in interest rate expense, except this one. So as we get 12 months into the beginning of, or from the beginning and into a rate hike cycle, in every other instance, there has been more interest to pay. Not this time, though, because corporates accumulated huge amounts of cheap money loans at essentially zero rates or close to it during COVID. Well, that's typically a 5-year kind of loan, and that would mean that it's going to be rolling over this year. So the disparity in rates for all of these outsized redemptions should be quite large for quite a lot of this debt. And if the U.S. continues to outperform as much as it has been outperforming, well, then we're looking at a situation where the story is all the more difficult because that outperformance is creating higher rates, just as the rest of the global economy that isn't the U.S. is having an increasingly hard time with growth and would not appreciate borrowing costs that are higher. And so what we end up with then is the lopsided nature of the pie becoming a major concern for global credit and for financial stability. In fact, the IIF in its report is pointedly warning that liquidity risk is increasingly a concern as things move forward. And that's what makes this PMI data such a big deal. Consider here the Citigroup Economic Surprise Index, which is showing us that for the Eurozone, the tendency for economic data has been to increasingly underperform relative to forecasts, whereas for the US, it has been pointed in the polar opposite direction. So if what we're going to look at here is surprise risk on the upside for the US and surprise risk on the downside for the Eurozone, if we're going to essentially, looking back at these overall numbers, end up with greater weakness here, but greater strength here, then this disparity at the heart of the story ends up looking wider. The wider the disparity, the more this becomes an issue. Because higher U.S. growth means higher U.S. rates, means higher rates everywhere, but everywhere is increasingly struggling to stomach it, especially if at the time this is what beckons ahead. So putting all of it together tells you that even as you get strong U.S. economic data, and even as that, at face value, encourages risk appetite, you may well get a negative response from markets as they look through and find in that data this, and begin to get worried that what this means is ultimately divestment and a more risk-averse perspective. As a matter of fact, that is precisely the logic that we've seen show up in stock markets in December. They've, of course, recovered and sit back at their December highs, currently looking at the S&P 500. But that spooking in December that led the sell-off, that was about rising rates. That was about this right here. And to the extent that this has scope to shutter markets again, because that disparity is looking increasingly lopsided in the PMI data, what may look like U.S. strength may in fact end up a growing concern for equities and for risk-oriented assets more broadly. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. I'm back with Chris for Futures Power Hour Fridays and Mondays, on with Victor Jones for The Price of Truth on Tuesdays, as well as with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as on Blue Sky. Thanks very much for joining. Macro Money's back next week. Take care.